Hey traders, welcome back to Trade Empire. In this video, you will learn our best pullback trading strategy. And we will cover these following topics. And we will break down the key criteria and important rules that elevate a pullback to a high probability trade. And we will explain all these topics briefly and clearly in a simple way, so you can easily learn and can apply in your trading setups. See you after a short intro. The first question is, what is the definition of pullback? A pullback is a temporary reversal, or a minor pause in the price action, against the prevailing trend. It occurs when buyers and sellers contend for dominance in the market, leads to a trending or any impulsive movement that created internal liquidity, characterized by inefficiency or static liquidity, awaiting to be swept or filled. In simple words, the price experiences a reversal and a brief interruption against the dominant trend, fills the internal liquidity, or clearing static liquidity, before continuing in its overall trending direction. In any market, a price movement consists of three main sub-movements: impulse, corrective, and continuation. If we consider this corrective move as a valid pullback, then we have this clear and valid break of structure. And we can also identify any order block or demand zone situated at the bottom attributed to the break of structure. And if this type of scenario happens in the market, then what we have to do is to wait for the price to tap into our highlighted demand zone and show us any sign of reversing its direction to the upside. And after finding any trend-shifting reason, like any candlestick confirmation, we will execute our long position here, stop loss below the demand zone, and we will target the recent swing high as our take profit. Now let's imagine a scenario where our highlighted pullback proves to be invalid. In such a case, our highlighted order block loses its validity. That's why we did not set pending order here. Now let's have a quick breakdown of candlestick uptrends and downtrends. A candlestick-based uptrend is characterized by a pattern in which the price action produces consecutive bullish candles, and each candle exceeds the highest point of the previous one, signifying a strong uptrend. And it is essential that the lowest point of each candle remains equal or higher than the lowest point of the previous candles. This condition indicates the bearish momentum in the market is restricted, and the market is in a strong bullish trend. Bearish scenario is the vice versa of bullish scenario. A candlestick-based bearish trend is characterized by a pattern in which the price action creates consecutive bearish candles, and each candle exceeds the lowest point of the previous one. And it is essential that the highest point of each candle remains equal to or lower than the highest point of the previous candle. How to identify a valid pullback in the market? In a bullish trend, a valid pullback occurs when a candle breaks below the lowest point of the previous candle, or just sweep its liquidity by the wick only. Here on the screen, the first red candle has broken the low of the third white bullish candle, indicating a valid pullback. But if the price fails to break below the lowest point of the last bullish candle, that pullback will not be considered as valid. Same concept applies for the bearish scenario. When a candle breaks above the high of the last bearish candle, it can be a body close pullback, or it can be just a liquidity sweep by the wick pullback. Both will be considered as valid because the main purpose of pullback is to grab the liquidity. In pullback, candle color does not matter. Here's another example. We can see that market is in a bearish trend, and we have this impulse move before corrective move, and we have these candles followed by a temporary pause. These are the highest and lowest points of the last candle of this impulse move before corrective move, and we can clearly see that none of these candles has surpassed the high of this last candle. and the liquidity has not been grabbed, so we will not consider this pullback as valid. And we will consider it as one impulsive move. As I told earlier, a valid pullback will be confirmed when price will break above the high of the last bearish candle and sweep the liquidity. Here's another example. Market is in a downtrend, and this is the impulse move before corrective move. Let me mark the high and low point of the last candle of this bearish impulse move. And we can clearly see that the high of this candle has been taken. And then price continues its overall direction to the downside. So, we will consider this pullback as valid. Pullbacks can be categorized into three distinct models: aggressive pullbacks, corrective pullbacks, and sweeping pullbacks. Let's learn about these pullbacks in details, and learn that how you can use them to increase your trading profits and decrease unnecessary losses. Let's start from aggressive pullback. An aggressive pullback is a sudden and significant price reversal after a strong uptrend or downtrend, characterized by rapid price movement and high trading volumes. And it occurs a couple of large and heavy momentum candles that quickly retrace a portion of the recent price movement. Here's an example of aggressive pullback. We can clearly see that market is in an uptrend. And this is the latest impulsive move, and this is an aggressive retracement or pullback. We can see that the pullback strength is very strong, and we have heavy momentum candles in the pullback, showing the strength of sellers. And when we have this type of pullback, we will not recommend you to open any trade without confirmation, because when price retraced aggressively in a continuation trend, there's a high chance that market will change its direction. And that's what actually happened. Market shifted its trend to the downside due to aggressive sellers in the market. Corrective pullback. A corrective pullback is a temporary price decline or reversal with multiple smaller candles. In this type of pullback, price can generate several internal structures until it reaches any point of interest or order block. Here's an example of corrective pullback. We can see that we are in an uptrend, and this is the recent valid break of structure. And we also have this bullish order block here. And we believe that price will respect our highlighted order block, and will reverse from there to the upside. As I told earlier, that in corrective pullback, price forms several internal structures, with multiple small candles, until it reaches any point of interest or order block. In this type of pullback scenario, we consider entering in the market when price tap into our highlighted order block. We can set our pending buy order at the top of this order block zone and wait for the price to trigger our order. And the second method is wait until price reaches into our highlighted order block, then shift into the lower time frame and look for any change of character. Then find another demand zone or order block, and then execute your position. Next we have the sweeping pullback. A sweeping pullback is a type of price correction where the price swiftly and aggressively pulls back to a specific support level, often sweeping liquidity through stop-loss orders and liquidity pools, before potentially resuming its original trend. Recognizing a liquidity sweep pattern before the price reaches our highlighted order block or point of interest is very essential, because liquidity patterns confirms the strength of our demand and supply area. Always remember, market always requires liquidity to continue moving in one direction and to keep its momentum stable. But if the price does not sweep liquidity before reaching to any key level, it often uses that zone as liquidity to fuel its momentum. Here's an illustrative example of sweeping pullback. We can see that before reaching to our order block, price has created equal lows during the pullback. As we know, liquidity can be found below equal lows, because a lot of pending orders and stop-loss of traders are resting there. And remember, the presence of liquidity above our highlighted zone provides additional confirmations for a potential price reversal from our highlighted point of interest or order block. After finding the equal lows as our liquidity sweep pattern, we will wait for the price to tap into our highlighted order block. And you can see, the liquidity below the equal lows has been swept. And price is now in our point of interest. And now you just have to find any candlestick, like any hammer candle or any bullish engulfing candle. And after finding that, you can execute your long position here. Stop loss below the order block zone, and you can target the recent swing high as your take profit. Or you can shift into the lower time frame and find any change of character there. Then execute your long position with full confirmation. That's all for today, guys. If this video has provided you some knowledge, please leave a like and subscribe the channel for more trading content. Wish you good luck for your trading journey.